What is the next gold in terms of growth potential? Well, our next guest thinks it could be metals related to the electrification of the economy. Peter Grandich, founder of Peter Grandich and Company, is back with us. Peter, our viewers have asked for you to come back ever since you appeared on the program again last summer. So I'm happy you answered their call. I'm happy you're here today. Thank you for being here.
Well, thank them, and it's really my pleasure to be here, David, so I look forward to this.
Thank you. And Peter, let's talk about the calls that you've made over the years. We'll start with that. As you know, gold has had a tremendous run. We've talked about this last summer. You had made the correct call to go pretty much all in on gold in 2018 when it was around $1,200. And of course, we saw what happened to gold in the subsequent years. Walk us through that call. Walk us through your rationale of going all in on the yellow metal a couple years ago.
Sure. I'll start right after when my wife said, I think you're crazy. And I decided to sell most of my general equities and put it mostly in physical bullion and mining shares at that time. At that time, it was difficult, almost like I called the Maytag repairman. It was very lonely to be a very adamant bull. But needless to say, we caught the run mostly up to the 2000 level, bailed out of, came back in, but focused more on the mining shares than the physical bullion these days, simply because I'm not in the camp of $5,000 or $10,000 gold. I do think you can get to 22, 2300. That's always been my target. And from this point on, while that be a 20, 25% move in bullion, the mining shares now and the leverage that they offer, particularly to producers, seem to have much more upside. So for me personally, I'm much more overweighted in the mining shares than physical bullion going forward. And I really think we're seeing the last of the correctiveness of that semi-parabolic move we had in the summer that took us, to almost adjust it for inflation, new highs. They weren't all-time highs, but they were almost there. So I think we're going to revisit them as early as the latter part of this year and no later than next year. And there, the mining shares are going to offer more opportunity, in my view, than the actual physical bullion.
So, Peter, I'm wondering if you think that gold has only a few $100s of upside left. You said 2,200 to 2,300. Why do you think the mining shares would have substantially more upside if the mining shares prices are usually based on the underlying metal?
Well, that's not necessarily true, and they've been able to separate themselves in recent years. The first thing is, the argument there has become very, very bullish for the mining shares. First of all, reserves are down 50% in the last decade. There's a great need and a shortage of new great deposits to come online. Second of all, even at that level, and when you say, a 25% gain is still not too shabby to think that that's what gold can go to, but for producers, almost all of that falls to the bottom line now. So they'll see a much better percentage return if that happens. And if that's the case, they still can double or even triple. And doubling or tripling in a couple of years used to be a decent target. Now people feel that if you don't do it in the next day or week, you're underperforming. But I still think there's substantial upside. And there is the opportunity to go past the 22, 2300. We'd have to see certain dire things get worse. But for now, I think that's a good target to have.
Yeah, you're right, Peter. Usually in a bull market, the miners have more leverage and they outperform. I've spoken to executives of a few miners. I won't name which, but some of them have lagged behind the precious metals last year. Usually when that happens, Peter, as an investor, what kind of questions would come to your mind?
Well, sometimes it is their own performance, but more times than not, it's a very fragmented industry compared to when I used to be very active in it. It has a lot of competition that didn't exist before. Start with cryptocurrencies, go over to the pot stocks, go over to the fact that we've never seen such high complacency and so much enthusiasm in general equities. So there's been a lot of competition that those companies have had to compete against. And that may be, and it's also very hard for them to communicate now. Not only has the pandemic impacted their way to get new investor interest, but it's become very difficult for, say, Canadian-based companies to get U.S. investors involved, regulatory and otherwise, has prevented that when it didn't exist 10 or 20 years ago. So they still have a lot of challenges to get their fair share of recognition.
Now, you showed me this chart. I'd like to show the audience now. It shows the gold price versus the S&P 500 total return index over the last 20 years or so, since 2000. And this chart, during that time frame, as we can see, gold has substantially outperformed the S&P 500 index. First of all, why do you think this has happened? And what's the significance of this chart, you think?
Well, I think the latter question is the more important one, and that is, and I use it for two reasons. I suggest to people to understand that here in the U.S., 2/3 of those giving financial advice now have only been licensed since after the new millennium started. And so for that reason, they really only withstood a financial crisis in 2008 and a very sharp blip down last year. Other than that, it's been a one-way street, and it's been basically a bullish environment. And if you took a poll to most of those same advisors and asked them, what do you think has performed best since the new millennium started, stocks or gold? Almost all of them would say stocks. And yet the real truth of the matter is gold has outperformed it. But it also takes me to the other thing that I speak about gold. Gold is kryptonite to the financial service industry. It flies in the face of what they're in the business to sell and advise on. And, whether you want to call it a relic and the other names that have been given to it, the bottom line is it's been in a stealth bull market since the new millennium. And, of course, it's never going to receive overall bullishness from the general equity markets, because if you really believe in why you should own gold, it's not the same reasons that you want to own general equity. So I point that out to people, and to keep that in mind, that despite the feeling, especially when you own junior resource stocks, and that's usually the people that get most depressed because they tend to be underperforming more times than they overperform. It's very important to recognize that gold has still been what it's been for a couple thousand years, and that's been a preserver of wealth and really something that keeps its purchasing power.
Peter, I'm looking at this chart, and the first question I have that comes to my mind is, do you think that over the last 20 years, the time frame of this chart, do you think that our economy, our living standards in America have deteriorated?
Oh, it's no question, especially in the last several years, that we've had only a small percentage. Nothing shows it more than what's happened in the pandemic. People talk about the 1%. I really use the 10%. About 10% of the people moved forward over the last 12 months or so. The rest of the crowd has fought to stay where they are, slipped, or actually fell, and many have lost businesses, jobs, careers, and their entire future. So there's no question in my mind that more people, or the vast amount of people, are worse off now than in the last 10 or 20 years than they were beforehand. So when you think about that, something has to give, David. The 90% have to catch up to the 10%. The 10% have to come back to the 90%, or they got to meet somewhere in between. It's probably the latter.
Yeah.
And that's why, I think also you have to be very concerned now about how far extended the general equity market is. And the view on Wall Street is not the view that most of the people on Main Street have.
There's just this prevalent view amongst investors that gold is a hedge against many things, one of them being economic deterioration. And I wonder if that's something that you have in the back of your mind when you buy gold. You expect the economy to perform poorly. That's why you want to protect yourself with gold. Is that why?
No, that's a reason, but it's not the reason. The reason for me to own it now is the same way I would own general equities at one time. I think it's going to be a capital gain. I don't try to get too caught up into all the craziness and all the things about it. I will say this. There's no question there's a debasing of currencies going on. There's a race to the bottom around the world. And that, again, is very favorable for gold long term as well.